Good morning, everyone. Today is Saturday, the 13th of August, 2011. Let's take a look at this market. We did get a little bit of a bounce here on Thursday and Friday. Friday was a little bit more of a just kind of gap higher a little bit and chop sideways throughout the day. I didn't trade on Friday, and it looks like I didn't really miss a whole bunch there. So hopefully, if you were trading, it was a good day for you. But we did get above that first level that was supposed to be resistance here at this about 117.35 and held above it as well. We still have a declining 5-day moving average. So early next week, in a nice scenario would be, especially if you're in cash, would be a pullback down towards that 5-day moving average, and then we could maybe begin to bounce a little bit with a little bit more conviction. If we take a look at what would we look for in terms of potential upside, well, we can look at we'll look at Fibonacci first because I just have it, but a 38.2% retracement of the highs from July to the recent lows would bring us approximately up to that 120 level. So 120 looks like a possible area. We found a little bit of resistance just below that gap low. So, the market, if we can stair step higher here a little bit, but it's incredibly difficult to trust this market still. Don't think that just because we're down a whole bunch and it's beginning to bounce. Look at how the volume is drying up here almost right away, that we have heavy volume on the downside, and relative to the sell-off volume, the bounce volume is much lighter, and that tells us the buyers just aren't that aggressive and still somewhat suspicious. And I think that's the way we need to be as well. Looking again at 2008 here, this was the real large sell-off in September into early October, and then we had a bounce. We kind of chopped around, tied the lows, looked like, well, we have a double bottom. I remember people calling that a double bottom, and then a bounce up and just smashed everyone through there. And then, just a real choppy recovery back to more downside. And it wasn't until that real bleed out in March of 2009 where we had the low. And that low is what we've been measuring against for a couple things. If we take a look at that low from 2009, and we take the volume weighted average price as we did this week, it came in right almost exactly on that number, and that's almost the precise level where we bottomed out this week. That level was also an area of interest, as we noted, because it was a significant retracement level from those lows too. So if we take the lows from 2009 up to this year's highs, you can see that the 38.2% retracement for the SPY, we had almost precisely and in that same exact spot. That's what the Monday night blog post was about. And it doesn't mean, though, oh well, I should have just bought there. What you wanted to do was look for evidence on the shorter term time frames, and really it wasn't. Tuesday was a good day for if you caught some of the long side in the afternoon, but it was a difficult day. Thursday though was a nice steady uptrend throughout the day, and like I said, Friday just kind of a complete waste of time, and I'm saying that without actually having traded it. So it might have felt differently, but I don't think so. So if we get this retracement in terms of Fibonacci off of these highs, then our first level would be about 120, 119.60. That's where we see that declining 10-day moving average right now. So we also have to take a look, though, of course, at prior levels of support that would potentially have the ability to turn into resistance here. So let's just clear this screen back up. Here's where we are right now, or kind of what we've gotten up to this week, and I didn't draw that so well, so let's clear that again. But this little low prior from a week ago Friday, the afternoon low, is what we got up to. The next level of significance here on this chart would be this next lower high, and each one of these lower highs will likely become an area that is contended, and even this level here. So you could look at it and say, well, 120, 180, and then about 124.20. See how that ties in, and maybe there's a couple of these levels that tie in with a Fibonacci that would give it more validation of that level. So you can see this is a general area, this 38% retracement, and that's the way we want to look at it. But again, don't trust this market. Don't feel like you got the bottom. Maybe you did, but protect yourself with stops. I'm not saying you didn't catch the bottom if you have a good price and you're up 6, 7%, 8%, and it's in your IRA and you're looking to hold it for 2 years. I don't think that that's likely the scenario. Maybe we continue to bounce up towards the neckline of that head and shoulders, and that could still get us up towards 125. I think it seems unlikely, but let's let the market speak to us rather than put our opinions, force our opinions on the market. The Nasdaq did bounce, a little bit better here in terms of where relative to where it broke down from. If you remember, the real breakdown didn't occur at this bigger support at 54. The real breakdown for the Nasdaq 2 weeks ago was at the 57 level, and the 57 level is where we have these moving averages that were clustered, the 50, the 100, and 150 day. So that was equivalent to basically the breakdown in the SPY at 120, 126, 125.80. This breakdown here was pretty much the equivalent of the Nasdaq breaking through 57. Now, when it breaks through 57, what you would generally expect is that it's going to come down and try to find some stability at that 54 level, because 54 has been an important level throughout the year. So let's just go back like this and emphasize that. But instead, it just sliced right through it, and it was actually kind of evil how it did it, because a lot of support buyers, ended up buying this day, and then it gapped down significantly and closed near the lows. So that was a brutal time for the Nasdaq. But here we are back up to this prior important level of support, and now the declining 10-day moving average, and we've got a declining 20 and 50 as well. We're rallying up on lighter volume, so it looks like this is the classic type of bounce in a downtrend that should fail, at least come back down in towards that 52 level. Maybe it holds the 5-day moving average. I wouldn't really be looking for that so much, but be aware that that's a possibility. But this market really is just very difficult to trust. Don't feel as though the worst is over. We clearly do not know that. We broke this downtrend. We're below this prior support level, and maybe we bounce up through there just to get people, maybe we head in towards 54 and a half, 55, and then the market runs out of steam and turns right back down and does something similar to what the SPY did in 2008, which is it test the low and then exceed the low. And after these large sell-offs like this, that's what we often see. We saw it this year with silver. That silver broke down real hard, and it did get a bounce, but made a lower low just 3-4 days later. That's the type of situation we could be in. And then silver's been just kind of chopping back and forth, trying to rebuild here. But we have to be aware of what are these, kind of historical charts that we can look at and say, how has the market acted in a similar type of volatility, and it really doesn't favor a continued bounce, or definitely doesn't encourage or the thoughts of a full recovery and that we're going to be okay and move back onto new bull market highs. The market's been damaged very deeply here, and now we're experiencing the aftershocks. The aftershocks will keep coming, and it's similar to in an earthquake that you get this big rumbling, it causes all this damage, and then people are nervous, they're on edge, and you continue to see the aftershocks. And the aftershocks are, this was an incredibly volatile week. For the week, we were down, the semiconductors were up very slightly, but we're down 0.5% in the Nasdaq, 1.5% in the SPY. So it doesn't seem that bad, but we were down obviously much worse. But back to the Russell 2000, this, it had broken past this important level here at $70 a share. Let's call it 69.70. And it's trying to hold above that, but it's kind of gone sideways as well. The Russell's gotten beat up really badly. All these markets we're seeing big fear, big volume on the downside, followed by diminishing volume and diminishing confidence on the part of the buyers as the market rallies back up. The buyers are nervous, they're not rushing in, the shorts don't appear to be in a big hurry to cover their positions, and it's not going to take much to spook them again. It's, everyone's going to, just the smallest aftershock, people are just going to just scamper under their desk and think that the worst is coming again. So we've got a very fragile environment, in other words, that we're operating in, and for that reason, you don't let your confidence soar because of a couple good days. Always play defense. I'll say that till they throw dirt over my box. We've got this is the bigger obvious level, 77. That's a huge way off. I don't think that's realistic to look at as far as potential resistance. If we take a look at the most recent leg lower, some Fibonacci, then you'd be looking at about 71, then 73 and a half ish. But again, we what we'd like to see is a pullback first and a little bit more shakeout. But if we start continuing back down below some of these levels, and in the SPY, if we're going to continue back down through 115, 116, new lows could be coming and coming quickly. If we drop through 53 and then 52 and a half fails, Nasdaq could be in trouble too. So keep your guard really high. Semiconductors bounced a little bit up. They were up for the week, 0.27%. They were at their declining 10-day moving average. This group has been a lot less volatile than the broader market, which is unusual for them. That is to be less volatile, but that was the case this week. And they're trying to find some stability like the rest of this market. It doesn't occur all at once. If they there's that phrase that if they don't scare you out, then they'll wear you out, and then there's going to be a lot of wearing back and forth on the buyers and sellers in here. So short-term trades are really how you have to keep it best, and you can get blindsided by anything with all the macro, the economic news throughout the globe. So the semiconductors, if they can hold 29, then maybe they can stage a little bit further recovery. But uh, we got a 38.2% retracement in here of the most recent leg lower. And if we can kind of pull back and then head for the next level, then I think that 50% retracement looks like the decent area to go to. Financials, they're a mess. They continue to be a mess. I don't trade them. I don't really always like to talk about them, especially today, so I'm not going to. Gold is, a lot of people are looking for the top in gold. It doesn't seem like a top yet. It seems like a couple days of pullback, and it's in this massive uptrend. The reasons that gold are up don't seem to be dissipating at all. So, it's innocent till proven guilty. You got to figure out which time frame you're trading on if you're trading gold. But it's been holding this rising 5-day moving average really well. If it's to close below that 5-day moving average and some of this recent levels near 168, then maybe that's something that you would need to move to the sidelines in. But trying to short this beast, I think, doesn't make a whole lot of sense. Anyway, that's it. Hope everyone has a good weekend, and talk to you Monday. Thanks.